Hey guys, this is Bruce Marshall from Simpler Trading, and if you are a trader or an investor, I've got a great video for you. In this one, we are going to talk about the most important part of trading, which is the P&L. And I get asked all the time about when to take a stop loss or where to put targets, things like that. And if you have been trading for any length of time, you've heard the old saying, making money is the easy part and keeping it is the hard part. And that is true in trading. And so because of that, I put together a short video here with the top 10 reasons of when to get out of a trade. So let's jump right in, and I'm actually going to switch this over to Google. And we'll just use this as an example. This works on anything that you are trading. But first of all, whenever you are going into a trade, when you start a trade, you have to have a plan. Everyone needs a plan for every trade they do, and that plan is, what kind of strategy you're going to use, and what's your time frame, and what's your objective, and your theory for the trade. Is it going up or down, and how long it's going to take to get there, that type thing. But you need concrete numbers around your plan, and that is, what is your profit target? What is your percentage goal? What is your dollar goal? What is your percentage loss? What is your max loss? Do you have a line in the sand? That kind of thing. Very important to have. I use percentage numbers and dollar numbers, and it helps me. And I actually can, I will sometimes even put those down on a post-it note and stick it on my monitor or something, because I'm old school. But it helps, and it keeps you focused on what to look out for in a trade. So, first of all, have a plan, and now let's jump into the top 10 reasons. And with a plan, we know what our P&L should look like. So, for example, let's say we do a trade that cost $5,000, just picking a number here, $5,000. And we are willing, on a trade, you have to be willing, if it's going up and down, especially if you're trading, you have to be willing to, to be able to have a little loss, because it has to ebb and flow with the market, right? So if you say, okay, I'm willing to lose $500 on this trade, that's number one. We look at our P&L. When you get down to $4,500, get out of the trade. If that's your number, your number may be 1,500. It comes back to your trading plan. But of the top 10 reasons to get out of a trade, the number one reason is your P&L, because that's real money. That's what's actually going on in your account. So if you say, I can only lose $1,000. Once you lose it, pull the plug. That's reason number one. Reason number two is very similar, but in this case, it's a percentage amount. If I say, again, I'm going to let this trade go 10% against me, 20% against me, 25, whatever the number is. It really does need to be, 50 or more, but 10, 20% is probably reasonable. Again, everyone has their own numbers. So number one in our top 10 list is your actual P&L. Number two is a percentage that you're willing to let the trade go against you. And in getting into the number three reasons, I kind of take a step back and look at the fundamentals of the trade. I've been trading for almost 34 years, and I came up on the fundamental side way back in the day. We're going to talk about fundamentals and then technicals. So on the fundamental side, if you're in a company that has a fundamental change in the company or the industry, get out or consider getting out. And what I mean by that is a new technology is going to make it obsolete, or the industry, for example, maybe it's the tourism industry. When COVID hit, there's a fundamental change. It's going to be around for a while. Get out. The tourism industry is going to suffer because no one's traveling and that type of thing. Those kind of examples. The fourth reason, so that's number three reason. Number four is watch the earnings. If a company gives guidance that significantly goes against your theory for the trade, such as we're experiencing cost increases, inflation, whatever, delays, whatever, you guys know, you've watched these conference calls after the earnings reports. If something fundamentally changes with the direction of the company, get out. Don't wait. Just get out. That's the sure thing. When the CEO is telling you there's a problem, Get out. So that is number four. Number five is an analyst downgrade. For example, if you have Goldman Sachs comes out and says, you know, because of the change in customer buying or the change in whatever the reason is, we're going to downgrade this stock or this industry, again, get out, and those can really make a big difference. Now, I'm not saying, knee-jerk reaction on every analyst, but there's a difference in analyst downgrade on, say, a valuation. We're cutting our price target from, well, let's see, in this case, $3,000 to $29.50. Yeah, that's not a fundamental reason. I'm talking about a fundamental reason, a change in something materially with the company. So that is number 5. Now let's switch back and look at what we've got here on this chart, and this is the technical side. And for the technical side, I use the number 1 reason, or the number 1 technical reason is fib levels, Fibonacci levels. And here are Fibonacci levels on Google, and as you can see, let me make this a little bit bigger. As you can see, these are very helpful. This is done off Dynamic Trader, and as you can see, we've got targets up here, we've got support down here below us that we're coming into. So if we're coming up to these levels or down to these levels, depending on which way we're going, if we're going down and these levels do not hold and we start breaking these levels, get out. And you already know what the number is over here. It's 2760. It's 2727. The 20. What is that? 2696, etc. Same thing on the upside. If you come up here, typically you're going to hit this. These are going to be resistance on the upside, and you may pull back a couple of times before you may get through there. But have a target up here. Have it already in mind, and be ready to pull the plug when you get to one of these levels, being a Fibonacci level. Very, very important. The next reason is number 7, and that is our VooDoo Lines. And VooDoo Lines here are a tool that we have here at Simpler Trading. These colored lines, these are Elliott wave levels, and they're very powerful. They work very well. And the way I use these, the strongest level is the red level. That's a fire line, so that typically is a magnet to draw price up to that. If you're coming down into this level, as over here, it would act as support, and you typically would not go through it. This also actually probably would be a resistance level that you probably would not get through, at least on the first time. And the next level would be the green levels. Those are tree lines. And then the third level that we really primarily watch are the white lines, which are snow lines. So again, you can see we tag these levels and fail, and we come down here. This actually held at the snow line, this held, etc. So we watch these for turns in stock prices, and if it were to break one of your levels, your predetermined level, because you know where the level is, right? If you say, if this comes down here, this is Google. If we come down here and we break that level, 2734 on the downside, get out. You can always get back in, but get out at your predetermined level. Don't, once you break a level or you have a number in mind, don't say, well, I'll give it a little more time. I'll see what happens. You're just throwing your plan out the window, right? Okay, so VooDoo Lines are number 7. Number 8, I like to use 8 and 21 moving averages, simple moving averages here. And these are pretty easy to follow. Every trading platform has these. Your 20-day moving average and 21-day moving average and your 8-day moving average here. Now we're following the light blue as 8. Typically in an up market, again, this is our bullish market, this is Google. So we're going up here and we're at the we're at the 8-day moving average. We come down. Look how many times we came down and tapped the 21-day and did not break it, right? Right there, over and over and over. This is a 1-year chart, so this is a pretty long period of time. But look, notice right there, you see those moving averages, they crossed over right there. That's a bearish signal. Once you break below this 21-day, the 8 crosses below it, that's a turn for the worse. That's why it goes down like this, right? And guess what happens right there? They cross back over to the downside, and then you get a lot of follow through on the downside. So I use the 8 and 21 when those cross over. That's your signal. Say, okay, I'm out, and I'll get out and I will jump back in when they cross back over to the upside. Check that out, it's right there. And guess what? We go higher. Now the 8 and 21 is a very common moving averages for people to use. You can go, I also like to do combinations of these things, but I like to do the 20 and the 50. So this gives you a little bit longer time frame. So this is a 20-day, 20-day, 50-day, and this is actually a 200-day. But what I want to show you here is on the same thing. On a 20-day, we came down into the 50-day average there. We touched it, bounced. 20-day, we bounced, and right here is where the crossover happened. See those averages crossed over right there, and right here you would have gotten out, right? When you break that 50-day right there is a signal to, in my opinion, to get out, if that is your trigger to get out, right? And again, when they cross back, maybe you get back in and you ride it up here, and then you come back down, you break this, etc. Everyone has to trade their own set of rules and guidelines and that type thing, but that gives you a really good idea. And the number 10 reason, and I'm going to go back through them here in a second, is our average true range. And these are average true ranges, which are on, this is a Thinkorswim chart. And we always revert back to the mean being the middle. If you're channeling up or down, stocks go like this, typically higher highs, higher lows, and they work their way up and up. Well, the middle is, the mean, which is right there. And as you can see here, again, this is Google. I'm just picking a stock. It could be any stock or any index. Typically, when you come down to that white line, which is the mean, in this case, we chopped along the mean here and we bounced. And this is +3 ATR right here. And we ride up here and we come back down. We went through it a little bit, kind of chopped around, bounced back up to 3 ATR, bounced back up to 3 ATR. Now, when we crossed over here, we start going down. And again, when we crossed here, we start really coming down. So these are, this is +1 ATR, this is +2, this is +3. +1, +2, +3, and this is -1, -2, -3. So you can set up a level here and say, if I break on the downside, say -2 ATR or +2 ATR on the upside, I'm going to get out. I'm going to wait for the smoke to clear and find out what's going on, that type thing. Again, there's a lot of ways to use this. I'm giving you kind of a generic way to do it, but that's a pretty good way to do it, is to go up here to the +2 or -2 ATRs, or even 3 if you're a little more aggressive. But again, just giving you some concepts, some general concepts here. These are all things that we can do, with the exception of VooDoo Lines, because those are come through simpler. But they're based on Elliott wave. You can get Elliott wave levels, from various places. But these are super easy things that you can do to give you a reason to get out of a trade or seriously consider getting out of a trade. Then, of course, depends on what time frame you're trading and, and that type of thing, how deep you want to go into looking at, levels. Do we want to go to the 5-minute chart or a 10-minute, 30-minute chart, that kind of thing? Or we're just going to use daily charts. Depends on your trade, if you've got 60 days left on it, or if you're going to trade it out today or tomorrow. So lots of variables, but I wanted to give you the top 10 reasons to get out of a trade. And again, I'll go through them real quick. Number 1 is your P&L. That's your actual dollars, right? That's the number 1 thing to worry about. Number 2 is the percentage loss that you expect to have and bail out on the trade. I'm willing to lose 10%. I'm willing to lose 20%, whatever, as an example. Number 3, fundamental change in the company or the industry that the company is in. Number 4, earnings guidance lowered is a biggie, obviously. Number 5, analysts downgrade for fundamental reasons, not for price type reasons, but for fundamental reasons. There's a change in the way the company is operating. Then on the technical side, number 6, Fibonacci levels, support, resistance. We have extensions and all of the things that go along with Fibonacci levels. Really rely on Fibonacci levels heavily. Number 7 are the VooDoo Lines, which are Elliott wave lines. Number 8 is the simple 8 and 21 simple moving averages. Number 9 is the 20 and 50 day simple moving averages. And number 10 are average true range levels, which I've got showing on the screen. And again, here at plus 2 ATR there, you can see the price over here is 26.94, etc. So that would be your level, or that would be a level to consider. So again, top 10 reasons to get out of a trade or consider getting out of a trade, give you a big heads up and give you a red warning flag. You can use this on indexes as well, and I do quite often. But remember, follow these simple steps, follow these simple rules. We're here to make your trading life easier. These will help you and get you better trading results if you follow the rules, have a plan, follow the rules as always. And come see us at Simpler Trading. Come see me. My name is Bruce Marshall in the bias room or in the main trading room there. I can help you and will help you any way I can. So hope that helps. Hope it makes sense. If you have questions, you can leave comments down below or reach out to us at Simpler Trading, and we are here to help. So thanks for your time. I appreciate it, and talk to you soon. Take care.
Without Simpler Trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency. It's one of the things that won me